The three big sector overweights have done quite well, and we've had a pro-cyclical tilt, particularly tilted towards the global consumer. So industrials, technology, and consumer discretionary have really driven returns, particularly in places where the demand was depressed or there was a lot of fear about demand, China and Japan. So everything from media companies to auto retailers to retailers, apparel retailers, sporting goods stores, all of those have done quite well for us during the quarter. Our underweighting in the UK has hurt a bit. The UK was very strong for the quarter, and we were underweight the UK. Overweight emerging markets in Asia, but our underweighting in the UK as that recovery is really been going on for a long time. It's a little bit later in the cycle, and some of our timing signals are negative there, but for the quarter they did quite well. Stock selection was great in the UK, but we're less than half the weight in the UK. That hurt. In Brazil was the one place where domestic demand stocks did not do well, and there was mostly a rebound in some of the energy names and some of the commodity names where we don't have an investment. So Brazil hurt a little bit, and the underweight in the UK was the biggest detractor for the quarter. We're a contrarian investor in our strategies, and in small caps in particular, we look for those companies that have great long-term growth potential, but rather than forecasting that, we like to go into those situations where that has been the case in the long term, but in the short term, demand's been a bit depressed, and that led us to those consumer-related stocks. In Europe, for example, in construction, housing sales are 10% of the prior peak, not off, of the prior peak. That's pretty depressed. Auto sales are at 5 to 7 year lows. So you can see we can go in there, buy the greatest companies, the best positioned companies, the highest quality companies, with very low expectations that have been extrapolated forever. You know, as we've talked about in the past, the concept of secular stagnation is growth never. And we thought growth never was a little too negative, and we bought into those companies with low expectations. So they didn't do great. They just did much better than expected, and actually in places like Japan is delivering the best earnings growth in the world. So Japan went from a 20-year basket case to the best earnings growth in the world. One of the things that's consistent and reproducible, short-term results, of course, when they're very good, we say they're skill, but let's say there's a skill and luck involved from a standpoint of risk. We execute our strategy conscious of integrating quality and timing tools and fundamental momentum, and understand the additional risk of investing in smaller companies. So the thing that's very different than our overall peer group is the risk profile. So we have the high returns of international small cap with less risk than the average international large cap fund. So to me, having the top risk-adjusted returns, particularly in downside capture, we offer the least, I always say the best downside capture, but that sounds not very correct, does it? So we have the least downside capture within the category relative to our peers. So paying attention to capital preservation, quality, making sure that in the last month of the quarter there was a bit of a give back in a lot of places, and we tended to be flat, making sure that we have fundamental momentum in addition to price momentum, meaning rising earnings and rising expectations and positive surprises. So delivering that very, very low risk in what can be a very high risk category is a big differentiator, and that's fairly rare in this space, which can be quite volatile. It's a function of our bottom-up process, and the same combination of factors. In fact, quality is incredibly important, and timing and momentum tools are incredibly important in emerging markets. So it's really stock by stock. Sometimes have an unusual blend of companies in emerging markets. As I said, in Brazil, didn't work last quarter, but it's worked well over the last year, where we have consumer stocks in Brazil, where people think of Brazil mostly as agricultural and exports of steel and iron ore and oil. So we have a very different mix with our emerging markets, and it's really where we find that combination of quality, growth, and momentum and value. we see is one of the most powerful themes that are impacting our strategy in a positive way is the powerful restructuring in Asia, India, China, and Japan. And this is a change in leadership and a change in culture, but really is reflected in how each of those countries allocate capital. And they're changing the way they allocate capital. In India, less bureaucratically. In China, with market-driven forces. In Japan, of course, with a focus on ROE and profitability and growth. All of these are profound changes in the way these countries will invest and orient their economies. And it creates dramatically improving returns on capital, better growth, and to have the three of the largest economies in the world and the leading economies of Asia do this at the same time is one of the major most important trends we see over the next decade.